Welcome to the Show Me the Money podcast, Unlocking Property Finance. Join us on an exciting journey into the world of property finance, where we uncover secrets, strategies, and opportunities that can turn your property dreams into a lucrative reality. Welcome to Show Me the Money, Unlocking Property Finance.
Okay, hello everybody. Welcome to the Show Me the Money podcast. This is the second episode where myself and Marc talk about the secrets of unlocking property finance. For those of you who've not listened to our podcast before, I'm Sharma. I'm a property investment developer based in London. Got experience doing HMOs, and I also work with young professional tenants as well as supported living for housing associations. And I also do planning uplifts, working on joint ventures with vendors coming from a background of construction, project management, finance, and the military. And a quick reminder of Marc for everybody.
Well, mine's less long-winded than that. I'm a broker. I find the money for people and hopefully make their dreams come true and becoming millionaires through property.
So there's amazing.
It's it's a bit more succinct, but yeah, in essence, we've both got the same aim and goal to make money for ourselves and make money for other people.
Absolutely. So Sophia, myself and Marc actually met out in Mickham earlier this year, and after enjoying some fine food and wine, we had discussions about getting the series going and bringing on some really helpful, insightful guests such as yourself. So thanks for joining us. Do you want to give us a bit of an introduction? Tell us a little bit about yourself, what you do, your background, and I think this conversation is just going to flow really well from there.
Yeah, of course. Thank you for having me on to the first one. I feel quite honoured actually to be invited on as your first guest. But I started off at Natwest and RBS in your corporate and commercial banking really, and I think for me, I've always really had a property interest, just purely because my family are all in property at the minute. So from then on, I moved to the Challenger Bank. So I was at Synergy Bank for a couple of years doing property investment, so your buy-to-let and your development finance. And then I moved to Avamore. So I'm now at Avamore as a relationship manager covering London, and I'm just doing development finance and bridging here.
Wow. And so we have a crossover. All three of us have worked for RBS.
There we go.
Yeah, and none of us at the same time though. I was there 2004 to 2007. You were a bit later, were you?
So I was actually at Barclays, but I did when I was management consulting. We did do a bit of work with RBS. I remember certainly doing quite a few pitches there for consulting work. So I didn't specifically, but some of my team did.
Mm-hmm. And how about you, Sophia? When were you there?
I was there between 2016 and 2018. So I was in the Gatwick corporate team.
Wow, with one of my friends, Ian Collins.
Yeah, I was actually in his team.
Yeah, nice guy. He runs a mod type shop in Beckenham or somewhere now.
That's
anyway,
it.
Yeah, small world. Yes. So
everyone's connected.
That's how it is though in property. Everybody seems to know everybody, and I suppose that's one of the great things about this podcast is bringing people together and talking about property and how people can succeed from property. So you mentioned, Sophia, you're from Avamore. I know Avamore very well. We've done a lot of transactions. Do you want to tell us a bit about Avamore and where they sit in the market?
Yeah, of course. So we're still quite a young company. We've been going since 2015. We started off as a small team of about 4 and 5. Really and truly, I think we kind of built our name in the market because we innovated a product for part complete development, which is, funnily enough, prior to COVID as well. So it was stepping in at any stage of the build. So if someone, there's a lot of reasons this could happen. We went through a period last year that unfortunately contractors went bust, lenders pulled out the market and that kind of thing. So it's not necessarily something going wrong in a development, but we like to step in and provide a solution to get the development finished, and everyone's got that overall goal to get the deal completed and move on to the next one kind of thing. But overall, we're a development lender that it's not just your ground up developments, but we cover your refurbs and conversions, say anything from, you know, buying a house, doing it up and selling it on, to your office to resi conversions, your extensions and that kind of thing. But now we also do a lot of bridging. So we only really were known to be like a development lender that only done bridging when there was a development angle on the back end, but kind of changed it up a little bit now, where we've got fee scales for evaluations and legals, and we're doing bridging just as quickly as our peers in the market, which is good.
Good. And you mentioned about the development exit product, so part complete. Obviously, that's a riskier area of the transaction to be working, because if something's gone wrong, then you know that causes extra risk. What telltale signs can a customer be looking at to make sure they don't get to that point? What sort of things can they be doing to protect against them making mistakes and having these issues? And I don't want to talk you out of any deals, because you do the front bit as well. But how can they avoid getting into trouble?
I think it's just doing your research, really. I mean, we do support first-time developers and that kind of thing as well, but just finding out, you know, speaking to the right professionals, ensuring that you've got enough of a contingency buffer in there. Sometimes you genuinely, you know, you see materials go up all the time, you're seeing delays in your bricks and timber and that kind of thing. That really, it's just making sure that you've got the right costs. And also,
so what is the right contingency? 5%, 10%?
Generally, I like to see 10%. You know, if you've got a developer who's been doing it for a very long time, then 5%, 7.5% is generally okay. But yeah, 10% I think is a good amount. I mean, some people are requesting 15, 20% on a contingency. You know, I think it's always good for the developer as well. Sometimes you go over on something that you're not expecting to go over on, and then you think, oh no, I'm going to eat up into a budget somewhere else. But yeah, generally I'd say about 10%.
Okay, Ro, what do you put in yours? 5 or 10?
Depends on the type of project. If it's something I've done before, you know, if it's not been too long since I did that, and there hasn't been too many macroeconomic impacting events, then I'd expect the costs to be broadly the same if I can evidence it. So depending on the size of the deal and the conversion, or if it's a new build, for example, will dictate. I mean, 5 to 10% is what I've typically worked on. But I guess linked to that as well, it'd be good to actually understand what goes on behind the scenes. So Marc and I have discussed at length on the previous show, the process that is involved in borrowing, and, you know, what happens behind the scenes from the lender's perspective. So it'd be really helpful actually to perhaps if you could explain, for the benefit of the audience, what happens when you receive an application first. Who looks at it? So obviously we're working on the assumption that it comes via an intermediary, so someone like Marc at War Financial. What's the first thing you do? Which are the departments that need to look at that deal, and how do you validate things such as the build cost and whether there is enough contingency in there? It'd be good just to understand that sort of process flow, and then I can probably ask a few more questions then about the build cost, contingency, and various other bits, which I'm sure you'll enlighten us with.
Yeah, absolutely. I mean, it depends how detailed the initial proposal is to us. Sometimes we'll just see, you know, an address, this is the market value or purchase price, you've got GDV, and this is the build cost, and they want the 12-month facility, away you go kind of thing. Generally speaking, with something like that, I always look at the address. I always look, you know, what's the area. I generally look at comparables, you know, what's sold in the area, is there demand there over the past few years, that kind of thing. Are they setting a completely new price point in the market? You know, so all of this stuff you always want to look at, especially just looking at the location.
Can I just ask a question on that? When you look for comparables, because that's the one thing that we try and talk to our customers about and make sure they're realistic. So they'll go on there and they'll say, do you know what, we found this HMO, whatever, it's going to be worth 500,000. And then you look on net house prices, whatever it may be, and every other one has been sold for like 240, 230, and you're like, definitely not. What is there a particular source or site that they can go on and look at sold comparables?
I mean, for me, being in the sales team, when I see the initial inquiry, I will normally go on just on Rightmove, look at past 2 years, within a quarter mile, half mile, you know, what's been sold. Also have a look at just what's in the market. Generally speaking, with credit, they'll probably delve into it a little bit more and have better tools than what I'm using myself. But generally speaking, I just go on to things like Rightmove. There's generally
So
enough data there.
So you do like the first pass. So you do the initial look at the application, and you do some cursory checks on the due diligence in terms of sold prices and that sort of thing.
Yeah.
What else do you do before it goes on to the next person? Who is that next person, and then what do they do?
Yeah, absolutely. So for me, when it comes in, I also look at the build cost. For me, it's, you know, if someone sends me a ground up development and it's less than £100 per square foot, I'm really going to back a little bit or just give a bit of feedback. Generally speaking, you know, there's a refurb and there's only about, you know, it's wind and watertight and there's not much left to finish off, and you're about £30-40 per square foot, it would kind of make sense. Or, you know, if it is a self build and they're not appointing a main contractor, then we might get comfortable, you know, with the build cost being a little bit lower than normal. But generally speaking, I think, you know, at least £150 per square foot when it's a ground up development, especially in this day and age. You know, when we're seeing things on the back end, one thing that we'll always probably pride ourselves is we never actually lost money on a deal. And I think when you've got enough there, you know, we do appoint professionals like your monitoring surveyor who will evaluate that, but having that at the front end and being able to give that advice, you know, how many deals we've seen from start to finish, just being able to have that knowledge. You know, for example, if you were to give me a deal somewhere in Kent, you know, we would have had one that we would have completed on recently, just that we can compare, you know, these are the build costs that they completed on there, and that kind of thing, really. So yeah, generally that's as far as I'll go and looking at build costs myself. But so from me, it will go to an internal relationship manager and credit analyst. So they will kind of review the deal ready for credit, and that's where they'll delve in a little bit more. They'll look at the full development appraisal. So they'll look at the full budget of costs from, you know, start to finish. They'll also have a look at the client's assets and liabilities. So for assets, you know, how much equity do they have in there? Generally, we like to see around 25% of the gross loan or something like that to kind of gain comfort. But that's when they'll have a real look into the actual client and who we're lending to, have a look at the borrowing SPV, that kind of thing. And also experience, you know, looking at previous comparable schemes. If it's their first scheme, are they appointing a good contractor that has the experience? You know, have we got their details on file? And that's really, when it goes into credit, it's probably where we delve into it a little bit more.
And can I just ask, you said you wanted 25% equity. Can that come from investor finance? And if so, what due diligence would you do on the investor who's putting in that 25%?
Of course. So generally speaking, I mean, we are okay. We have had it before where, you know, there has been an investor involved, but because they are part of the SPV, that the clients actually put no funds in themselves, and we've managed to get comfortable on that front. So I think it all depends on how much the client has, you know, in terms of their net assets, if we do need a PG from the investor and that kind of thing. I think we look at everything on a case by case basis. What
we're seeing a lot of, and we go to a lot of networking events, and we see a lot of new start investors. They're usually looking to get their first deal, and you do first time developers.
Yeah.
And they can only do that with full investor finance. And that investor generally doesn't want to put a PG in. They just want to be away from everything. They want to stick their money in and get that money plus a bit more on the way out. And any risk, they just want to, you know, mitigate as much as possible. So I think you're going to see more and more of that, in my opinion. That's the thing I'm seeing on the ground. But
it's definitely quite common. And I think also, you know, it's on a fixed return, tends to be on a fixed return basis as well. So it's effectively debt rather than an equity type of investment. And as Marc said, they don't want to have exposure to personal guarantees and don't want to be on the SPV. So in that sort of circumstance, how do you deal with that? Because that is certainly something that people will be listening to have looked at or have done before. How do you go about reviewing those sorts of deals?
Yeah, absolutely. I mean, a lot of the time that we will see deals where the client has got strong assets, you know, they just don't have any liquid cash or that kind of thing. You know, you might see that they've they're currently involved in 2 or 3 other projects, and you can see that their money is there, and they're close to the end of the projects, and they are going to sell it out and get some equity back in time. I think in a situation like that, we can be more flexible. Whereas if you've got someone who's probably a first time developer, they have never done any schemes before, they haven't got any assets of their own, and there is a equity investor there, that's probably when we're more likely to say, actually, can they join the SPV? Because normally, we probably wouldn't get comfortable with that client standalone, I'd say.
And another question off the back of that then.
Yeah.
If you've got investor finance being put in and
Yeah.
the investor is charging an interest rate or a profit share, that's obviously going to have an impact on the figures of the development, because the developer will be less likely to make a profit if things go wrong, because obviously their profit would be halved, or a lot of it will go away with the debt servicing. Would that be taken into account as well when looking at figures?
Yeah, definitely, for us. I mean, generally speaking, when someone's got an investor, they will have a sort of breakdown of how they are going to charge it over the term and that kind of thing. So we will always put that into our figures at the start. So we have an overall sort of hard profit for the client. Generally, we say 15%, but we can go down to 10%, which is quite flexible in comparison to our peers in the market, to be honest. So yeah, generally speaking, we will look at that.
Yeah, and
Is that 15% on the? Sorry, I was just going to ask a question about the profit. So would that be 15% on the cost of the project, or 15% on the okay, not on the GDV?
Yeah, 15% profit on cost. Generally.
Okay.
Yeah, because I've done I was trying to do a transaction with you guys, and it was last summer, and the actual profit was coming down and down and down as materials were going up and up and up, and there were time delays, and it ended up with myself and the underwriter discussing the project and saying, this doesn't make sense for the customer anymore. And we went to the customer and we said, look, we don't think this is the right thing for you to do. We believe you'll be better off pulling out of this deal now than progressing with this. So we added, I suppose, extra value to the customer as a sounding board and as a partnership between lender and broker, where we had 2 people saying the same thing to the customer: you shouldn't be progressing with this, you're going to get yourself in a mess. And we probably, in hindsight, saved him a lot of money and time, and he was very grateful, and he's still coming back to us with transactions now. So I think we made the right.
That's a really interesting point, because I think, especially as someone who puts deals together, you put your heart and soul into it sometimes, and everyone is at risk of becoming a motivated buyer, because you spent so much time and energy in trying to make this deal work. Then the last thing you'll do is walk away from it, because the lender or your intermediary is actually advising you against it. But it's great that you do that, because you need people looking at it from a fresh pair of eyes. So it's really interesting to hear that.
It was tough for me, because I, as a broker, only get paid on deals that I complete. So
yeah, indeed,
doing the right thing was obviously the right thing to do, but it doesn't pay the bills at the end of the day.
That's it. I think when it comes to profit, there's different ways you can look at it. For example, if you've got a client that they're doing a light refurb on a property, and there isn't profit in that scheme, but there's a long-term investment goal, and it's a high-yielding property, for example, then we can look to take a view when it is something like that. I think, generally speaking, at the minute, when it's actually ground-up development and there's not much profit there, it's something that I'm probably saying more than I've ever said before, is I think you're actually overpaying for the site, which is something that I never really said over the past couple of years, but recently it's something that I seem to be saying.
Would you say, and that's a really interesting observation, would you say that is more to do with deals that people had secured a price on probably 6-12 months before, or is that even, you're still seeing that on deals that people are securing now as well? Because obviously we are seeing this dip in capital values, and I believe strongly now is a really, really good time to be doing deals. But I recognise a lot of people might have option contracts or prices that they negotiated 12-18 months ago, possibly even.
Yeah, absolutely. I'd probably say a bit of both, to be honest. There is one scheme in particular that we've been working on for a while that they put the price in a long while back, and they basically, I think there's a few problems that they've had. They've had to apply for amendments in the planning and that kind of thing. And I've said at this point, you know, the amount of money that you've actually spent on the site and you've not even fully completed on the purchase yet. I think it's probably worth negotiating on that site now, you know, and there's more issues than probably anticipated at the start. But yeah, like you say, probably a bit of both, I'd say.
That's really nice. I really like that you kind of, you know, you give some guidance and advice to your potential borrowers as well, to say, look, this is what you need to be doing to make this deal work, other than, you know, or rather than just saying, actually, no, it's not enough in it. We can't do this.
Yeah.
So that's really interesting.
Definitely. I mean, like, everyone wants to make money, and you know, every deal potentially could fit your parameters and that kind of thing, but it's never the right thing to just proceed with the deal if you don't think it's going to be profitable for the client as well. I think that's a big thing for us.
Yeah, that makes complete sense, because the great thing is that you've got the benefit of seeing deals all the time, so you can kind of benchmark costs, you know, land acquisition values and all sorts of stuff, which, you know, we as borrowers don't see. Now, I've always thought it'd be really interesting to sit actually inside with a broker or a lender and just be there, part of the due diligence, you know, just absorbing all that knowledge and really seeing what goes on, what works well, what doesn't, how, you know, how things fly through and which things don't, and for what reason. That can really help us with our applications.
On that, Ro, I know you're a facts and figures kind of guy, and you like spreadsheets and things like that. I get a lot of the time, obviously facts and figures are very important and the most important, but gut feel and assessing from experience, I suppose, is really important as well. And you know, the escape room games that you do, where you have to break out of a room. When my wife and I have done these in the past, she goes on looking at the clues and the facts and going through everything, and I just press stuff because I've got a gut feel that, you know, I've got to press this part of the wall to let me out. And a lot of the time in property development, you need that intuition and the other side to it as well. So you can have all the facts and figures and everything work out, but you sometimes you need to take a risk. Sometimes you need to be looking at things that haven't worked for people previously, because at the end of the day, people make money when other people aren't doing that thing as well, and they're creating new trends. So for me, a big bit of advice for people listening are: get your facts and figures, make sure you have a tight ship, but then make sure you are also doing things innovatively and making sure that you are maximizing your potential by using your creativity. And then underwriters hear that and they're like, no, we're not lending.
Makes sense. What sort of timelines do you guys work to at Avamore? In terms of, you receive an application, how quickly can you turn around decisions? And then obviously there's the actual drawdowns as well, which is what this is all about. Tell us a little bit about the process that needs to take place before the money is actually drawn down by the borrower for that acquisition on completion day.
Yeah, of course. So we have heads of terms, which is credit committee every single day, basically. It's not just, you know, the credit team. You've got our CEO on there. You've got our head of investor relations, who deals directly with our funding lines. You've got our head of credit, head of underwriting, that kind of thing. Everyone kind of joins the call every day or in the meeting room every day. And generally, we just discuss every deal. You know, we've got our credit analysis and our internal relationship manager sort of sitting there presenting deals, and it's sort of not like a voting system, but to get everyone on board and say we're happy with the decision. We actually appoint an underwriter from day one once we've approved it. So a lot of people will wait until, you know, reports have come back and then it gets handed over at that stage, whereas we get an underwriter generally on a call with the client, you know, and the broker as well from day one. You know, this is what needs to get done. If you've got a timeline that you need to meet, we need to know about it now rather than waiting for the reports to come back. Like, it does also help when we're requesting the professional quotes on who can come out to site the quickest if it needs to be done, if it's an urgent case, for example, or, you know, some people have already exchanged by the time they come to us for full application. So we've got 28 days from 2 weeks ago, that kind of thing. So we do like to know up front, you know, how quickly they like to complete. And for us, generally speaking, you know, we use professionals that can go out onto site next day, you know, that week, next week, that kind of thing. So generally we'll get the reports back within a week or 2 weeks, probably max, really. And then from then on, once the underwriters are working on the case and it's going through legals, I generally say 2 to 3 weeks of completion once we've received the reports. I think one thing I'd say is on your bridging, when you've got quick purchases, your refinances and your auctions and that kind of thing, we'll generally get, stage 1 valuations out onto site the next day, get your report the day after that. Legals are instructed on a fee scale, and generally turnaround time is between 10 days to 2 weeks on that kind of stuff. So it depends on the deal specifically, I'd say.
Okay. That's encouraging. And so in terms of the reports you would normally commission, obviously you've got your valuations there who goes out. Obviously you instruct the legals as well. Once that's all, once all the necessary payments have been made to initiate that. Anything else that sometimes you do need to commission as well, which maybe perhaps a little bit off the beaten track, but perhaps something you're seeing more of?
It really does depend, case by case basis, to be honest. I mean, we've had one recently where the client has needed to go and get a batch survey or this kind of stuff. We always get, at the start. Sometimes you might need a structural report, but it really does depend. It's not something that we'll request as standard. Like for development, it's just your monitoring surveyor evaluation and your legals, and then for bridging, it's just your valuation and legals. But other than that, I think it's all case by case basis, I'd say.
Yeah, makes sense. When it comes to then the drawdowns for your, so let's say it's a refurbishment facility or a development facility after the acquisition. Generally speaking, people always need to spend money for the first kind of, for the first stage payment to then claim it back. Most lenders I've worked with or at least spoken to, that's how they work. Is that standard for you guys as well?
Yeah, absolutely. I mean, we will always draw down in arrears. For me, I think personally, if you're providing the funds, in advance, then anyone can do it at that stage. For us, we've got an internal asset management team, so we also appoint an external MS who will go out onto site. They'll review, verify that the payments have been made, and they'll verify the costs that have been spent, and we'll draw down against their certificate. But at the same time, we also have an internal team of asset managers who will keep on top of the deal. So, for example, if there are any delays, we'll be on top of it. We don't ever want to be in a position, we're not that kind of lender that will just put a client on a default rate and wait for them to get out on their own. We'll always try and find a solution to make things work. So it does help to have that team internally too.
Right, very good. Got a question for you on because you mentioned obviously you do a cursory review of all build costs when the applications come in as well. What are you typically seeing? So like in the southeast, let's say London for now, we're not talking prime central London, but what are you seeing in terms of light refurb, heavy refurb, and then new build cost per square foot?
I'd probably say light refurb. Yeah, light refurb, I'd probably say between £100 to £150 per square foot, really. Sometimes when it gets a bit heavier, I'd say about £180 to about £200 per square foot. Generally on your ground up developments, at least £200 per square foot, I'd say, especially in your London and South East prime areas, to be honest, at least £200 per square foot.
So Mark and I discussed this last time. Obviously, you get some people who manage builds themselves, and they'll put in quite low build costs because there's no overhead and profit for a main contractor, for example. How do you view those types of applications where someone is putting a build cost that they can achieve, but no one else would necessarily be able to achieve if they went under? How do you typically deal with those sorts of assessments of build costs?
Of course, I think for us, we're always going to be in a position that we will take it into consideration if a client is doing self-build rather than appointing a main contractor. I think for us, that is definitely something that our MS will take into consideration. But I'll always say we like to fund at market build. We won't charge you if you don't draw the whole thing. But if at any stage we have to take over the build, unfortunately, we don't have those contacts that are able to, do it for £25 per square foot or wherever it may be, to be honest. So we always like to have that buffer there. We won't, again, as I say, we're not going to charge you if you don't draw it. If you draw what you need, that's what you'll get charged on. But we like to have the full build facility there at market build, to be honest.
Makes sense. And what about project management then? Because again, a lot of people, for probably at the smaller end of the scale, will manage the projects themselves. What do you expect to see in terms of any allocations towards those management costs, if at all?
Yeah, I mean, to be honest with you, when it's management costs, there. Some people will put them in, some people won't. I mean, we don't generally like to see them sort of paying themselves in the build facility. Sometimes you see quite a large amount in there. We generally review those up front, if they are on site and that is what they're going to be doing, then of course you're always going to cater for those management costs for a project manager. But it does depend. It really does depend on the case. If you've got a light refurb and someone's being paid a lot more than normal, but they're not actually on site as much as expected, it's only
to watch the paint dry.
Yeah, exactly, that's it. And it's only sort of a 3-month term and that kind of thing, and you've got an extortionate amount, then of course it's something that we'll probably look at a little bit more. But if you've got a larger build and it is something that someone's essentially doing a full-time role and they've got a full team behind them as well, then definitely something that will be a little bit more lenient on, I'd say.
That's very, very, very helpful. I think I'm just watching the clock in terms. We're covering some great content here, but you got any more questions that you think we should try and cover with Sophia in the last few minutes?
I'm not so sure. There's one that we're going to end on to all our guests, and that is your top 3 tips for property investors or developers that you could give.
Okay, I think the first tip would be do your research. Just not just on the area, but also just everything, the build, that kind of thing. I think it probably ties into another point that I'd say is just build a reliable network in terms of which professionals you're using. Could be your architects, your contractors. Just make sure you can rely on the professionals that you're using. You've had a look at their reviews, you've had a look at their previous projects and that kind of thing, so who typically you're going to be using on your scheme. Make sure they're trusted and that kind of thing, and seek professional advice, I'd say, from a broker like yourself, Marc. I think it is quite important. There's a lot of, as you know, there's
it's very
very important, exactly. And there's so many factors that go into one development scheme, for example, that you just wouldn't even think of it if it's your first time and that kind of thing. And even people that have done it for so long, they're so knowledgeable on how to get the project done, but in terms of the finance, that the market's constantly changing. So just I'd say seek financial advice.
Yes, good. Okay, well, that's great. Thanks, Sophia. I think we'll wrap it up there. Thank you for coming on, and we will hopefully have some more great content in our show in 2 weeks' time. So we're going to put these on every other Thursday, and hopefully people have enjoyed it and they're going to tune in going forward. So thanks a lot, Ro. Thanks, Sophia, and we'll say goodbye to everybody.
Thank you, Sophia.
Thanks, Marc.
Bye.
Fantastic having you on.
Thank you
Cheers,
for having me
guys.
on. Take care, guys. Bye.
That concludes another episode of Show Me the Money podcast, Unlocking Property Finance. Connect with us on social media, where we share additional tips, resources, and behind-the-scenes insights. Feel free to reach out to us with any questions or topics you'd like us to cover in future episodes. Until next time, keep exploring, keep learning, and keep making those smart investment moves. This has been Show Me the Money, Unlocking Property Finance.